Exchange-traded funds, or ETFs, are one of the most powerful tools for long-term wealth building, yet most beginners either misunderstand them or underestimate their true potential. At their core, an ETF is a basket of multiple assets combined into a single investment. Instead of selecting and managing individual stocks one by one, you invest in a diversified collection that already contains many companies within a single structure. This simplicity is the first reason ETFs are so powerful. You do not need advanced financial knowledge, deep market analysis, or constant monitoring of hundreds of companies. Instead, you choose a broad ETF and invest consistently over time. There is no need for constant prediction, emotional decision-making, or stress-driven trading. The system is designed to work quietly in the background. The second major advantage is diversification. A single ETF can contain dozens or even hundreds of companies across different industries and sectors. This spreads risk across the entire market, meaning that if one company performs poorly, others help balance the overall performance. This structure reduces the impact of individual failures and creates more stability in the long run. The third reason ETFs are powerful is long-term growth. Many ETFs are built to track major indexes such as the S&P 500, which represents a broad section of large, established companies. Historically, these indexes have shown long-term upward growth over decades. Even though short-term fluctuations are always present, it's not about short-term movement, it is about long-term direction. The fourth advantage is accessibility. ETFs allow beginners to start investing with relatively small amounts of money, making them one of the most approachable financial tools available. There's no requirement for large capital up front, and investors can gradually build their positions over time. This makes ETFs suitable for almost anyone who wants to begin building wealth. The fifth key benefit is compounding. As ETF investments grow in value over time, the returns themselves begin generating additional returns. This compounding effect becomes more powerful as years pass, turning consistent investing into exponential growth. However, compounding only works effectively when given enough time and consistency to develop fully. But the real foundation of ETF success is not selection, it is consistency. Wealth is not built through perfect timing or market prediction, but through disciplined, repeated investing over long periods. Even small investments made regularly can grow significantly when maintained over years, because time amplifies every contribution. Many beginners make the mistake of searching for the perfect ETF, but perfection is not the goal. Markets will always fluctuate, and no investment is free from short-term uncertainty. What truly matters is staying invested through all conditions, both rising and falling. Markets because long-term trends have historically moved upward despite temporary downturns. Emotional control plays a major role in ETF investing success. When markets decline, many investors panic and sell, locking in losses and missing future recoveries. Disciplined investors behave differently. They continue investing during downturns, understanding that lower prices often create better long-term opportunities rather than risks. Risk management is another important principle. While ETFs naturally reduce risk through diversification, investors still need to avoid concentrating everything into a single sector or narrow theme. Balanced allocation across different types of ETFs helps maintain stability and reduces exposure to unnecessary volatility. Automation further strengthens ETF investing by removing emotional decision-making. Setting up automatic regular contributions ensures consistency, regardless of market conditions or personal emotions. Over time, this creates a structured system where wealth builds quietly and steadily, without constant attention or effort. It is also important to understand that ETFs are not designed as get-rich-quick instruments. They are long-term wealth-building tools that reward patience, discipline, and time. Their strength lies in gradual growth rather than rapid gains, making them ideal for individuals who prioritize stability and long-term financial security. Three major insights clearly emerge. First, ETFs simplify investing and make it accessible for beginners. Second, diversification helps reduce risk while still enabling consistent growth. Third, long-term consistency is the true driver of wealth creation through ETFs. Ultimately, the investors who succeed with ETFs are not those who trade frequently or try to predict markets. But those who remain consistent over many years, because wealth is not created instantly, is built slowly, steadily, and quietly through the power of time and compounding.